Welcome all to the quarterly trust administration workshop with Pierro, Connor, and Strauss. We're very happy to be able to bring this to you every 3 months so that those of our clients who have enacted trust during that time period have an education on what to do next, what those administrative steps are. And if you have your own trust, didn't do it here, or if you're thinking about a trust, this is going to give you a very in-depth look at how trusts operate, the inner workings of a trust, the accounting tax provisions in the trust, and how the trust operates to serve you and your family. And we're going to go through this along with our guest for today. And we have Trustco Bank, which is our sponsor. And unfortunately, we were supposed to be with Trustco in their new conference center, but we have to do it virtually. So we're happy to be able to do it, but we would prefer to be there serving you sandwiches. And we have with us today Michael Bates from Trustco, who has been with us in the past and generously provides support so that we can bring this to you free of charge every quarter. Thank you, Michael, for Trustco's support. And we have an agenda. And our agenda is to bring to you things that are new. So we're in a new year, January of 2022. Trust planning basics, so the foundations of trusts, the related tax issues. And we have with us Dave Mysliwiec, who is with BYXBEE CPAs. And David, good morning, or good afternoon, I should say.
Good afternoon, yeah.
And Dave is going to be talking about the income tax returns that a trust files, how different types of trusts work, which are very, very important if you happen to be a trustee and have the responsibility to file those returns. We're going to look at different types of trusts, revocable, irrevocable, talk about some of the laws surrounding the use of trusts, in particular Medicaid. One of the trusts that we do, we call a Medicaid Asset Protection Trust, and that's something we'll touch on today, along with the revocable trusts and the tax-motivated trusts, general asset protection trusts, charitable trusts, all the different things that we use trusts for. And we like to call trusts the Swiss Army knife of estate planning. So whenever there's a need and you need a tool, most times when we're doing estate planning, the trust is the tool. So when you create a trust, it's a living trust, you create it and it has to be administered during your lifetime. So we'll talk about how that happens, what happens upon the death of the grantor, and how the trust transitions to the next level of trust and who those beneficiaries are and how that works. The tax reporting and accounting, both during lifetime and at death, and why people use trusts simply to avoid probate. We're going to talk about probate, what that is, some of the common misconceptions of probate, and how you can plan to keep yourself and your family out of court through the use of a well-designed trust plan. So here is this guy, President Biden, and he has something called the Build Back Better Act, and most of you have probably heard about that. If you follow the news shows, you follow the saga of the Build Back Better Act, and will pass the House of Representatives, didn't pass the Senate. Senators Manchin and Sinema would not come on board for the Build Back Better Act. It had in the beginning a number of very, very serious tax provisions that would have affected trusts in a major way. Those were all extracted, and they had a second version of the Build Back Better Act then. That didn't pass either. And now they're talking about bringing pieces of the Build Back Better Act back onto the marketplace. So right now we have estate tax exemptions, income tax rates and exemptions, capital gains taxes, gift taxes. We're going to touch on most of those taxes as we go through. But the premise of the legislation was that pretty much every tax was going to go up to be able to pay for the social programs and other programs that were going to be implemented. None of those passed, as I mentioned. So we'll just talk about the current tax regime. And one thing that everybody should know, and that is the current tax law is temporary. It was passed as part of a bill several years ago, but it had to have a sunset because of budgetary restrictions. So the current tax law, which we'll talk a little bit about again, expires, and this is an important date, December 31 of 2025. So we basically have about 3 more years on the current tax regime, absent anything in Washington. And then we're going to go back to the tax law that existed right now 5 years ago, but at that point, 8 years previously, with all of the resulting tax rates. So let's talk about this a little bit and look at our gift tax. If you give a gift, most people think that they can give away something without incurring any gift tax. And a lot of people think that $10,000, it's been going up every year. Last year it was $15,000. This year it's $16,000. So you can gift $16,000 per person per year to any number of beneficiaries. And if you're a married couple, you can double that and you can gift $32,000 per person per year without impacting your lifetime exemption against those gift and estate taxes. So if you're under $16,000 and it's just cash or securities, something easily valued, you don't even have to file a return. You can make those $16,000 gifts per person per year, and you can reduce the size of your estate. Question becomes, do you have to? What are the exemptions against the estate tax? And right now, you'll see the federal exemption there on the slide, $12,060,000. So everybody today, get your checkbooks out. You can write a check right now for $12,060,000 and you pay 0 gift tax. Now, people use that to get assets out of their estate. We work with high net worth families who have more than that, who need to do some tax planning. And remember, when the law changes, the magic date, December 31, 2025, that $12 million is going to get cut in half. So it's going to go back to $6 million when that change occurs. That will then coincide very closely with the New York State estate tax exemption, because yes, New York does tax people, and we have an income tax, capital gains tax, we have an estate tax. What we don't have is a gift tax. So even though the estate tax total exemption in New York is $6,110,000, you can have an estate of $6,110,000, you pay no tax. If you gift $6,110,000, you don't even file a return because there is no gift tax. So in New York, you can actually gift up to that $12,060,000. Federally, that's tax-free because of your exemption. And in New York, there is no tax on the $12,060,000 gift because there is no gift tax. It was repealed. Now, there is a provision, 2 provisions you need to know about the New York State estate tax. One is that there is a 3-year throwback rule, meaning if you give gifts, if you make that $12 million gift, you file your federal gift tax return. If you die within 3 years of making that gift, it comes back into your estate for tax purposes. So they call these deathbed gifts. In New York State, when it passed its legislation in 2014, took away the ability to make deathbed gifts. And if you make the gift and die within 3 years, it all comes back into your estate. The other provision of New York law that people need to know here is called the cliff. And in New York, you have the estate tax exemption of $6,110,000. And you may think that because of that exemption, you could pass $6,110,000 tax-free regardless of how much you have in your estate. Not true. If your estate goes over that, and if you hit 105% of the exemption in effect at the time of your death, so 5% more than $6,110,000, you don't pay tax just on that 5%. You pay tax on the entire amount, the 105%. So your tax bill, literally, when your estate goes up by $200,000, your tax bill goes up by $700,000. And so that cliff, if you have an estate that's borderline up around that $6 million, $5 million mark, you should think about doing some planning for New York state taxes And again, come 2026, January 1st, New York and Fed are going to both be around that $6 million number. Big numbers, right? How many people have $12 million, let alone $6 million? So for most people, what they referred to as the death tax, the estate tax, it's not relevant. You don't have any estate tax concern if you're under 5 million. You don't really need to think too hard about this. So should you make $16,000 gifts? Sure, if your kids need the money or grandkids need the money, but do you need to for tax purposes? For most people, the answer is no. We're going to talk about reasons to gift assets other than taxes as we go through the program, but I just wanted to set the stage for you as to when people make gifts, why they make gifts. The tax motivation for making gifts only applies if you get up around that $6 million mark. Otherwise, your estate is going to be tax-free. So let's flip it over to capital gains tax. And capital gains is incurred on assets that appreciate in value. So if I buy a stock and I buy the stock at 100 and the stock goes to 200, I have a $100 capital gain. Now there's no tax on that until I sell the stock. But when I sell it, I pay tax, capital gains tax on that $100,000. And how much tax I pay depends upon where my income falls. Federally, these are the federal rates. If you go up to $41,650 or $675 if you're single, or $83,350 if you're married, you pay zero. If you are $41,675 to $459,750, or on the married side, $83,350 to $517,200, you pay 15%. So most people are going to be in that 15% capital gains tax bracket federally. And if you get over those amounts, you pay it 20%. That's the maximum capital gains rate today. There was talk in the legislation to raise that to 28%. And there was talk of changing it to ordinary income tax rates, which the top rate is now 37%. But right now, status quo. The brackets have gone up a little bit to put you up into those higher rates, but these are the rates, those are the brackets, and that's what you need to know about federal capital gains tax. New York State also taxes capital gains. If you're watching us from New York City, we do have a Manhattan office. New York City taxes an additional amount on income and capital gains, another 3.6%. There's something called the net investment income tax of an additional 3.8%. So capital gains taxes can creep up there when you combine the federal. New York's rate goes up close to 10% now. The net investment income tax, which is another tax that layers on. If you're in New York City, an additional tax, that capital gains rate can be very high. One of the saving graces and one of the tenets of trust planning is if your estate isn't over that $6 million threshold, one of the benefits you want to keep for assets that have appreciated, and that can be real estate, your home, could be a business, could be stocks, anything that has appreciation, that gets a step up in basis upon death. So that $100 purchase price with a $200 stock, if that is in my trust and it's properly structured, my heirs are going to get a new basis of $200 upon my death, and they can sell the stock with zero capital gains tax. So one of the things that we do in trust planning, and as we go through and talk about these different kinds of trusts, is we structure the trust to achieve that step up in basis so that the heirs are going to inherit the capital assets, the appreciated assets, with a new cost basis. If you simply gift it to the kids, you put the kid's name on the deed and you gift it outright to them, they get a carryover basis. They get your original cost basis, and the gift comes with a little poison pill because when they sell, they're going to have to pay the capital gains tax. So these are the rates for capital gains tax federally. Again, New York is up 9-10% at the top rates, and that's about a 30% total for high net worth individuals in capital gains tax, which is a significant amount. So that's the tax overlay. Things that we're going to be talking about as we talk about the design of our trusts, looking at income taxes, looking at capital gains taxes, looking at gift and estate taxes. All of those become relevant in trust design, and we have to balance out our interests as we create trusts. The most basic type of trust is a revocable trust, and that's something you create very easily. We'll tell you how and why and what the purposes are of a revocable trust. That's a living trust. If you use a will, you're in probate, and that will, through the probate, can create what we call testamentary trusts. So you can do trusts for disabled children, for a spouse, for other children. You can put them in your will. And we're going to talk later about why that may not be the best way to do that planning. We plan for tax purposes. We plan for asset protection purposes. Those are irrevocable trusts. We plan for probate avoidance purposes. That is typically a revocable trust. And then we have specific trusts that deal with specific types of assets. A trust to hold life insurance, to receive IRAs, 401ks, and retirement plan benefits, specific trusts for children who have special needs, trusts that you want to last generation over generation. We call them dynasty trusts, perpetual trusts. Again, if you fear creditors, if you're in a high risk occupation and you don't want creditors to be able to reach your assets, sometimes people use these types of trusts for prenuptial agreements. You're getting married, you don't want to do a prenup, but you want to have your assets coming into the marriage protected. You can do an asset protection trust. We have to go outside New York for that, to another state, Nevada, Delaware, things like that. And one of the most important aspects of our practice lately has been not just to look at our client themselves and have a trust, revocable, irrevocable for them, but look at downstream, when you leave assets to your children, what's the best way to protect them and to give them control and flexibility, but allow them to have a leg up, because you can give them their assets in a beneficiary controlled trust that will protect them long term. So fundamentally, what is a trust? It's a contract. It's an agreement. And you'll see at the top of the trust, this trust agreement dated blank, January 25th, 2022. That contract has three parties to it. You have a grantor, someone who has assets that they want to utilize a trust to perform certain functions for them. And that's revocable, irrevocable, living, testamentary. You have a trust that you're going to create using your assets. You're the grantor. You hand those assets off to someone who you entrust to manage them for you. That is your trustee. And the trustee is then a fiduciary, which is a role that comes with responsibility. When you're a fiduciary, you're serving another, and you have something called fiduciary duties to that beneficiary. And the beneficiary is the third party to the contract. So you have grantor, hands assets to trustee, who manages them and utilizes them under the terms of the trust for the benefit of beneficiaries. Lifetime management of assets, a major advantage. Avoid probate, assure privacy, protect assets, reduce taxes, all of the things that we're going to talk about in the types of trusts and how they work. When you lift up the hood, how is that engine producing the result that we're looking for? In our firm, we take trust funding very, very seriously. And we do that because we see a lot of clients that come to us after someone has passed, and they say, well, mom and dad did this living trust 20 years ago, and we've got this beautiful binder. It's leatherette. It's wonderful, and all the documents are neatly stacked in there. And you ask, okay, so where are the assets titled? Are they titled in the name of the trust? Oh, I don't think so. Here are the statements. Here's the deed. Everything is still in their individual name. Well, the trust isn't working unless you retitle assets. And it doesn't have the same effect. It doesn't accomplish your goals unless you fund the trust. So this is an essential step in trust planning. So when you come into our office and you work with us to sign documents, and if you have a trust from us, this was your process. We draft the documents, you get the drafts, we review everything with you, we go over it line by line if you want to. Make sure everything is to your specification. We then schedule you for a document signing. And a lot of people, and in a lot of law firms, the document signing day is the end of the process. I call it halftime. And if you watch the 2 minutes of the Kansas City Buffalo game, you know that a lot of things happen in the second half. So we could score a lot of points in that second half. And you score points with trust funding by making sure that every asset is properly titled. We've given you a set of documents. Hopefully you've been able to download those, but they're with your package, and Beth talked about those right in the beginning. And Form 1 is your estate planning documents. And this is a checklist that we provide to you when you do your document signing. This is every document you sign and what will happen. How many copies do you get of each document? Where do you keep the originals? Where do you keep the copies? Good questions and common questions that clients have. So we give a sheet, Form number 1, that you should be able to find in your packet. And this is the form you will receive at the document execution. Again, this is halftime in your estate planning process if you're doing a trust plan. If you're doing a will plan, you're pretty much done at the document signing. But with a trust plan, it's halftime. Storing your documents. We typically keep a set of originals here in our office. We give you a set of originals for most documents except the will. We keep the original will in our vault. And from there, you go about the trust funding process. So form number 2 in your kit is a trust funding letter, which is very detailed and shows you how each asset goes in and how the trusts get administered. A certification of trust, which is the document that you're going to use to give to the bank, to the brokerage, to the insurance company, so that you don't have to give them the entire trust. You provide them with a certification of trust. And that's the document that you use for trust funding. You will receive an attorney certified copy of your trust, actually 2 of those, and then a condensed trust funding worksheet, so that as you add assets to your trust, you record that on your trust funding worksheet. And this is part of our kit that we give to our clients. And then you send that back to us, and we prepare the last page of the trust, which is Schedule A. What you don't want to have is a blank Schedule A, because that means nothing's in your trust. You want to have a Schedule A that lists every asset that you placed in trust, and that's what we will provide to you. So what assets go into the trust, what assets do not? This depends upon what type of trust you're using. A revocable trust, which is the one that you are the grantor, so it's your assets going in. You're also the trustee because you're managing your own assets as the trustee during your lifetime while you're competent, and you're also the beneficiary. So the revocable trust doesn't really change your relationship to your assets. You're still the owner for all intents and purposes. So this trust isn't protecting assets for Medicaid. It isn't protecting assets if you have a lawsuit. What it is doing is providing a very comprehensive management tool that you design with our help. We draft the language, you tell us how you want it done. That if you do become incapacitated, it's going to help you manage your estate, your assets, with a succession of trustees, people that you trust, to have them be able to take advantage of all of the benefits that you have during your lifetime. And then one of the other keys is upon your death, it's going to avoid probate. So it avoids the probate process that would otherwise take usually a year, sometimes 2, sometimes 3. The trust avoids all of those things. Because of that, in a revocable trust situation, we want every asset that you have, with one notable exception, to be in the trust. So your home, your other real estate, bank accounts, brokerage accounts, life insurance, annuities, all of those things go into the trust. The one asset that does not is a retirement account, whether it be a qualified retirement account, an IRA, 401k, a Roth IRA. Those stay in your individual name. What's key there is that you want to make sure that the beneficiary designations for your retirement accounts and your other life insurance policies, things that have beneficiaries, are threaded into your plan. So it's woven together, and that you've coordinated. We work with you to make sure that this happens. Coordinated all the beneficiary designations on all of your other assets, retirement and other assets, so that it flows back appropriately through the trusts that you're leaving for your survivors. So the IRAs, 401ks don't change during lifetime, but they do change at death, and they come and become part of your plan. They avoid probate naturally simply by having the beneficiary designation on them, so they don't need to be retitled into the name of the trust. Irrevocable trusts, again, asset protection and tax planning are the two primary reasons for irrevocable trusts. And for this, we don't put all of the assets in because you want to keep immediate access and control of certain things, bank accounts, perhaps. We do put annuities in. And as I said, some bank accounts will stay out. So the trust funding process is going to be different depending upon the type of trust you use and what assets you have. There's no one size fits all for this. There's no formula. There's no cookie cutter that we can give you that says, okay, just take this document, go do it. Everything is tailored, everything is customized, including the trust funding process, which is extremely important. What about things that don't have title? Things like your coin collection. And we're getting more and more into the crypto world. So how do you leave cryptocurrencies? How do you leave your NFT collection? All things that we're learning about. That's a part of law that is really evolving, and we're keeping track of all of that and making sure we have appropriate assignments and control and access to the things that are hard to find and track, like cryptocurrencies. But what about your jewelry, your coin collection, your golf clubs, all the things that you have that are untitled assets? You will do an assignment. That's form number 5. So you'll see a category, a broad list of things that go into your trust. And because it's a trust, we're allowed to use an outside document. So we have a memorandum that says, okay, I want my diamond ring to go to my daughter. I want my diamond earrings to go to my other daughter. I want my pearls to go to my granddaughter. So you can specify specific items to go to specific people. That's a document that you have, that you will be able to use and to modify on your own, not coming back to the law firm every time you make changes there. And it's something that will help you to keep track of the things that are valuable: family photographs, memorabilia, antiques, art. All of those things are specifically bequested in that memorandum. And whatever's left, you'll have provisions in your trust to leave to a variety of people. With real estate, there are deeds that are done, and we deed properties into the trusts. For other things like business interests, if you have a limited liability company or corporation, you will assign, and we prepare the assignments, your membership interest, your corporate stock, your partnership interests. All of those things will go into your trust, and we will make sure that it gets done properly, that the deeds are done, and that the retitling of your business interests are all coordinated with your overall estate plan. So retirement accounts, I mentioned earlier, the key to this is the beneficiary designation. There is a law that went into effect in 2020. We've been talking about it now for 2 full years, but I don't think anybody fully understands it. They're still putting out regulations to interpret some of the provisions. But this is called the Secure Act, and it made major changes to the way retirement assets are left to the next generation. In essence, the government got tired of waiting for its money because careful planners were stretching out retirement accounts, IRAs, and 401ks over life expectancies of very young beneficiaries to continue the tax deferral and the accumulation of wealth inside of that tax deferred vehicle. Well, the Secure Act changed that. And with some certain exceptions, now every beneficiary has to liquidate the retirement account in 10 years. Well, if you think about those income tax rates, right now the rates are 37% federally at the top bracket, 10% New York State at the top bracket. And so those are high income tax rates, but they're going to get worse because that magic date of 1/1/26 goes back to 39.6%. So if you take the federal at almost 40% and New York at about 10%, you've got a combined 50% income tax rate for high earners, for high income individuals. And so planning carefully for your IRA now is very important, because I used to do a slide with just a time bomb with a fuse coming down. That's what IRAs are. Now it's worse because the fuse is much shorter. So you have to do planning. We have to weave in the beneficiary designations. We work very closely with your financial advisor. Maybe you want to consider a Roth conversion. Maybe you want to consider some other alternatives as the beneficiary of the trust. But the Secure Act has really changed the way this all works. If you have a disabled beneficiary, they can actually stretch. So we want to segregate off the benefits to a disabled beneficiary from your IRA, because we can have a trust for them, special needs trust, that they get lifetime deferral, and they can use a lifetime life expectancy table to defer the tax. But that's careful planning that you need to take into consideration. If you have large retirement accounts, that becomes a major aspect of your planning. As I mentioned on one of the earlier slides, we do standalone retirement trusts to deal with this 10-year payout issue and make sure that you have all the flexibility available for each individual beneficiary to maximize their deferral and maximize their stretch. If it's 10 years, it's 10 years, but if they can stretch longer due to a variety of circumstances, and one of those is chronically ill individuals, and you don't know someone has chronic illness sometimes until you die, and they may have it at that time. Well, the trust would protect them and allow them to continue the stretch in a protected trust. So we do standalone retirement trusts for large retirement accounts to make sure that we're maximizing the long-term benefit, because those tax rates, up to a 50% tax rate for high income individuals, once that law changes in 2026, we need to be cognizant of that and to plan for it. Taking a step back, our most basic trust, the revocable trust, this is a diagram. And for those of you that have worked with me, you know I'm a big fan of diagrams. I like to draw them on legal pads. We have them here in some slides. So this diagram shows you the grantor, you of the revocable trust, putting assets in. You're the beneficiary of the income and the principal. You're the trustee, so you're managing that trust on your own behalf. During your lifetime, there's really very little change in your access or control over the assets inside the revocable trust. This is contingency planning. The two contingencies that we cover with the revocable trust are, what if you become incapacitated? What if you have an illness or an accident or an injury, and you lose the ability to pay your bills, manage your assets, manage your investments? You don't want your assets tied up. No one would have legal authority unless you have a power of attorney. That's the other way to plan for this. But in a trust, you get a successor trustee who comes in when a physician determines that you're unable to manage on your own behalf. The successor trustee has specific defined powers that you give them, defined uses of the money, how to invest it, how to use it, who to use it for, protecting you and your beneficiaries. And the trust gives you the best chance of success in this regard, keeping you out of that guardianship court. Again, we never want to have our clients dragged through the courts. So the revocable trust is our best defense to keeping out of guardianship court during lifetime and making sure that assets are well managed and handled on your behalf. Upon death, this trust goes right on to the beneficiaries, family, heirs, creating trusts downstream for your beneficiaries, and it avoids the entire court process. We have literally administered revocable living trusts in one day in very certain specific cases. It takes a little longer depending on how many beneficiaries, but it's private, it's expedient, much less cost, as opposed to the court process of probate. And don't kid yourself, a lot of clients don't get this right. Every will must go through probate. Just because you have a will, you're not avoiding court. You're asking for it. You're putting your heirs, your executor in probate, in the surrogate's court. And that's something that you have to deal with at that point in time. So the trust funding here is an irrevocable trust. Different, yes. This is a trust, and a diagram again of a trust that we use to shield assets if you need long-term care. This is not a long-term care seminar, but suffice it to say that if you can't afford to pay $180,000 a year, going up every year, if your assets would be drained, if you had a prolonged need for long-term care in a nursing home or home health care, and if you don't have private insurance, private long-term care or life insurance with a rider allowing you to pay for it, the only other program out there to pay for nursing home care or home health care in New York is Medicaid. And Medicaid is a program that requires you to have a limited amount of assets. If you're single, that's $16,000. So we use this particular type of trust, what we call a Medicaid asset protection trust, to transfer assets in. In this case, you would not be your own trustee. So here we have our first fiduciary other than you, in the Medicaid Asset Protection Trust. And it's usually children or other people involved, nieces, nephews, brothers, sisters, family members, or friends that are going to manage that trust on your behalf. You get the income back, but to protect it for Medicaid, you can't get the principal back. That's the major difference here between the revocable trust and the Medicaid Asset Protection Trust. So principal stays locked in the trust, but you have an ability we're going to talk about to unlock it. Income to you for life. You get to live in your home. You get to use real property. You get to use rents from real property, all those things. So all the income stays with you, but we lock the principal away to preserve it for Medicaid. How tightly locked is that drum? The remainder men are going to get the property upon your death, full step up in basis, very favorable from an income tax perspective. Income to you, principal cannot be given to you, but the principal can come out the back door of the trust. So you have your home, bank account, stocks, bonds, annuities, life insurance, businesses, real estate, all those assets can go into this trust. And you can have the ability for your trustee, the person you put in place, to make distributions of principal to your children or other third parties. And once they receive it, there's no restriction on what they do with those funds. So they could, in fact, in a Medicaid Asset Protection Trust situation, use those assets back for your benefit. So you retain a right to have principal distributed to the beneficiaries, who then have no restrictions on their use of the money. They can, in fact, use it back for you. So for a lot of people, once they hear this, and believe me, clients come to us having heard all kinds of theories and misinformation, disinformation on how these trusts work. Do I have to run to my kids when I want money? We don't plan for that. So we do keep assets outside of this trust. You're going to keep a certain amount of cash, bank accounts, and you'll notice your IRAs, 401ks. Remember, we don't put them in the trust. Is that a risk for Medicaid purposes? In New York, the answer is no. Massachusetts, New Jersey, Connecticut, different story. But in New York, IRAs and 401ks are exempt assets for Medicaid. So we don't have to put them in the trust. So we keep our IRAs and 401ks. We get our required minimum distributions. We keep bank accounts. We keep enough cash so that we're comfortable that we can get whatever we need without having to dip into the trust. And if our trustee isn't doing what we ask them to do, we fire them. You have the absolute right to change trustees at any time. If the beneficiaries aren't doing the things you want them to do, you replace them. You have the right to change beneficiaries on this trust at any time. And here's the trick under New York law. Think about it. If you can change the beneficiaries and you're the grantor, under New York law, you can revoke an irrevocable trust with the consent of the grantor, you, and the beneficiaries who you name. So that irrevocable trust isn't as irrevocable as it sounds. And you can start this process, get that clock running, because there are look back periods, 5 years. Most of you have probably heard of that for Medicaid. Use this trust with enough flexibility that you can change trustees, change beneficiaries, principal can come out to those beneficiaries, and with their consent, you can actually revoke that irrevocable trust. So that's the irrevocable trust on the Medicaid side, how you design it. We do have some Medicaid changes that are coming up. We're going to be doing a series of webinars coming up in March. If you're interested in this topic, we have them on our website now, but we're going to have all the 2022 changes and all the guidance we've gotten from the New York State Department of Health on Medicaid, in particular Medicaid home care. And that will be a series of Monday seminars, webinars rather. We call it Medicaid Mondays in March, just for alliterative purposes. And you can join us for those Medicaid Mondays in March. Always check our website for the dates and times, but it's noon every Monday in March. We'll cover all the Medicaid topics. I want to bring David back on now. And we're very happy to have Dave Mysliwiec with us, first time presenter with us for the Trust Administration Workshop. And Dave, I think am I going to keep slide control, or is he going to take? Dave's going to take slide control at this point. And with that, I give you David Mysliwiec.
Great. Thank you, Lee. Okay. So I tend to babble, so I'm just going to babble and talk about things and maybe give you too much information. I'm not really sure, but I'm just going to follow the slide and we'll go for it. So with the trusts, there are always going to be separate types of trusts. And as listed here, I'm going to jump ahead a little bit. There's grantors, there's simple, and there's complex. Each one is treated differently for tax purposes, and each one is treated differently for legal purposes. So when Lou is setting up the trust for you, you want to make sure that he takes care of everything. You want him to do the SS4 so that the ID number is filled out properly. If you look at Form 7, you'll see that it's a relatively simple form to acquire an ID number for the trust, but I have seen them filled out incorrectly, and then the IRS will send you letters looking for different things that you really don't need to worry about. So when you have the trust done, just have the attorney do the form. Another thing that's important is the situs. So generally speaking, not always, but generally speaking, it's easier if, say in New York, the trustee and the grantor is set up. They're both here. You can have the trustee in different locations, but you want to make sure that the trust is set up where the state is New York and that the grantor is in New York, obviously, so that it makes things easier. Florida and New York have some very specific rules. Lou can talk about that at any time, or you can ask him separately. But with other states, you just want to make sure that everything is set up properly. For the different types of trust, just like for your personal tax return, for standard deduction, it's 12,200, I believe, this year. There's a standard deduction or exemption amount for each of the different trusts, except for the grantor trust, because the grantor trust flows through to you personally. But you want to make sure that, again, you either use a competent CPA, Lou can refer you to multiple people for that, and or you can use an H&R Block or someone. I don't generally recommend that, but there are some very, very competent trust specialists at H&R Block and at Liberty Tax. But you want to make sure that it's done by a professional. And I say this jokingly and seriously, because if I prepare your trust return and it's wrong, you can sue me, or I can be liable for different things. If you do it yourself, you're on the hook. So don't even take the chance. Just spend a little bit of money and get it done properly. But for Form 8, you'll see that talks about what you're looking to do when it comes to the actual trust return. It's a little packet. I'm going to skip over that for a second if this works. There we go. Oh, too far. So gifts and the impact on the estate tax return, or on the estate tax. So Lou spoke about this early on, where the exemption amount for New York is $6,110,000. And for federal, it's 6,110,000. And for federal, it's 12,060,000. New York State does not have gift tax. So as you mentioned earlier, you want to make sure that you speak to both your accountant and your attorney, and everybody's on board when you do this type of thing. But you can do such fantastic tax planning and trust planning by doing different types of gifting. You can do that $16,000 a year or $32,000 if you're married. You don't have to. It may come into play, it may not. You can set up different things, and not to go off topic, you can set up irrevocable life insurance trusts and fund it that way. You can do so many different things, which is why you really want to make sure that your attorney and your accountant are on the same page with you, and that you truly know what you're trying to accomplish, because Lou will guide you in the best way possible, but he needs to know what you're trying to accomplish to make that happen. And so income tax rules are different. And the irrevocable trust is a completely separate entity. So a revocable trust, as again Lou spoke about earlier, can flow through to your personal return and is taxed at your personal rates. The irrevocable return is taxed at tax rates, which are substantially higher than actual regular income rates, which you'll see below in the next screen. The rate is, I'm going to skip ahead just to talk about why you want to do that. So the rate, once you hit 13,500, you're at the maximum rate for an irrevocable trust, which is why you want to make sure that the planning is done properly. So I'll skip back real quick. So for definition, so a grantor trust, essentially it's a trust set up to protect you. The income literally still gets reported on your personal return. You do have a separate tax filing. There is a Form 1041. It It will have the information of the trust on it. I believe you have a sample in there. Form 9 is in there. That's not the proper form, but that's the same form you're going to use. It's a Form 1041. And for the grantor trust, there's an actual Internal Revenue Code section that gets printed right on it through our software that tells the government that it's a grantor trust and that all the income flows through to you personally and is taxed at your tax rates. You don't need a gift tax return. You have power of appointment, which is important right there. You have complete control over everything that's being done with that trust. So it has the legal protections that you need, but it's still treated as if it's your asset. Simple trust is a little different. It requires that all income be distributed. So if you're, generally speaking, it's going to be you and your spouse that are going to be the beneficiaries. So you will get that income usually quarterly, but it can be annually. And it is, you want to make sure that you put the proper assets into the simple trust. Capital gains, generally speaking, so if you had a mutual fund or if you have stocks in there that you sell, capital gains generally are not considered income. They're considered principal. So that is not distributed. So that's something to keep in mind when you're putting those assets in there. Also, the income, the flow through of that income does get taxed you personally. So it is taxed again at your individual tax rates, which again, with proper planning, all this can work, I don't want to say seamlessly, but can work very much to your benefit so that things are actually protected and taxed at a good rate. And again, watch the capital gains because those are kept in the trust, generally speaking, and they are in fact taxed at the trust rate. For a complex trust, that is one where you have discretion. You can decide if you want to distribute the income. You can decide if you don't want to distribute the income. And I don't think it's in the slides, but there's also a 65-day rule where you actually have the ability to, after the end of the year for the trust, you can go back and make a distribution effective, whether it's in January or February of the next year, and say it was for the prior year, which gives you a lot of planning capabilities. So if you have a surprise, mutual funds specifically, if they have a surprise distribution on December 30th or December 31st, and you don't have a lot of time to plan for it, it's a great way to use that rule and actually still get that money out and taxed at the ordinary, I'm sorry, at the individual tax rates versus the trust tax rates, which are a lot higher. So back to the screen about this. It looks ominous in a way because once you hit $13,050, you're at the highest tax rate. But if you plan everything correctly, again, between the attorney and the accountant, this can go very, very seamlessly. You can make sure that things are taxed properly, that they're taxed at the lowest rate possible, and that the proper assets are flowing through to the personal and the other one staying into the trust. So that's a big number though. At $13,050, you're paying 37%. So you're paying plus state. So you're paying well over a third, almost a half, not quite, but almost a half of the actual income is being taxed. So you're losing it. So you want to make sure that you plan this properly. So the definition of income, I jumped ahead again, I apologize. So money or property received as current. So it's interest, dividends, it can be rental income, it can be a lot of different things. But again, it's not going to be the actual principal itself, it's just the income from it. And I know Lou had mentioned the cryptocurrency thing. So that is a great example of there's no income generated from crypto. So it's something that you would not want to utilize in something here. But the other assets, bank accounts, dividend accounts, rental real estate, other types of investment income that will generate from this is a great way to get that to flow through and again, to protect those assets. So allocation of principal. So when you receive property, I'm sorry, when the trust receives the property, it's principal. It is an asset and it's not distributable per se. Money that you get from those assets is it's always going to be distributed. So from the simple trust standpoint, that will always be distributed. From the complex standpoint, the trustee then has that discretion. And it's, and I keep saying this over and over, but it's truly, truly so important that you make sure that you explain to your attorney, to Lou specifically, and to your accountant what you're trying to accomplish, so that all this will flow, and it will become almost second nature year after year after year as you're doing this, and it becomes very useful. And it will, and I hate to say it this way, I speak this way from personal experience. It could save lives in the sense that so much money can be saved. And that makes it very, very important as our parents or our grandparents get older, to make sure that that money's protected so it can be used for their benefit. And it truly can have a great benefit for them. Did that work? I think my slide is stuck. There we go. Oh, one too far. So, okay, sorry about that. So, uneven tax brackets. There's no correlation between individual tax brackets and trust tax brackets at all. So you really want to make sure that the income flows through properly. You want to make sure that you do that planning ahead of time. We have we do have dozens and dozens of planning meetings between the end of October and early December for our clients that are trust clients. And we speak with the attorney to make sure that everything's done properly. It just makes things fantastic. I'm a huge proponent of this. So hopefully it's exuding through the camera. So back to the 65-day rule. It's a great way to catch up if specifically mutual funds, they'll do some distributions the last week between Christmas and New Year's that you just can't plan for, and you can't get that money out right away. So the 65-day rule works fantastic. So you really have a little over 2 months to figure out. You can do a tax calculation. You can figure out how it's going to flow to the individual, what way it's better. Sometimes, depending on the tax bracket of the individual, you might want to leave some in the trust. That's not usually the case, but you may want to. And it also allows for some distributing of capital gains. And again, that's dependent on a couple of things. It depends on the wording of the trust and on the discretion of the trustee. And I know I ran through this quickly, and I'm going to open myself up for questions later, and you'll have on my information if you want to call me or email me questions later. But I'll bring back Lou right now so we can talk about the next slides.
Thank you, David. And this is important stuff. Once you create the trust and you get all of the wonderful glowing trust advantages, manipulating the trust and making it work for you is an ongoing duty. And we're going to talk about selecting a trustee who's responsible for all of this in just a moment. But the management of income taxes is one of the most important things that has to happen. Typically, when our clients create a trust, they're the grantors of the trust. We almost always, with certain very specific, narrow exceptions, structure that trust as, for income tax purposes, what's called the grantor trust. And David's going to walk you through a grantor trust return in a minute. That's the simplest kind of trust that you can have. Because of those compressed income tax brackets, it's generally the most advantageous type of trust to have, because all of the income tax consequences inside that trust naturally flow back to the grantor. So they just go right back on your 1040, and you don't have to worry about it. There's not a lot of concern. It just reports back to you as the grantor every year, and it goes on your 1040 just like it did before. When we use different types of trusts, upon the death of the original grantor, all trusts fall into this category. And for certain clients, we want to shift income tax out of their estate and have a non-grantor trust. For those, you hit that $13,200 income cap very quickly, and now you're in the 37% bracket, someday 39.6 on 1/1/26. And you're also hitting the higher New York State tax brackets as well. So this 65-day rule is how you manage that. And in fact, it does become an opportunity for certain clients. If you have this trust and you have several beneficiaries, and all the beneficiaries are in different tax brackets, have differing rates, you can sprinkle income from the trust to the taxpayer with the lowest income tax rate. They then pay the least amount of income tax on that income, even though it's being earned by the trust assets. So as David said, and this is really key, you need a team to do this level of planning, and you need your accountant on that team to manage with you the tax ramifications every year. And the reason they give you a 65-day rule is you don't get your 1099s and K1s typically till February. So you need the ability to get all of that tax information, do the analysis, and then make a determination as to distributions to various beneficiaries to carry out that distributable net income. And it's very powerful. It has to be managed on an annual basis, but it gives you an ability to really work that trust income and lower the tax on it. Lifetime administration of trust, I already covered this to some extent. For a revocable trust, again, very simple. The revocable trust, we call it your alter ego. When assets go in, you're the owner. It's on your 1040, goes right, stays right in your social security number. You don't even get a new tax ID number when you're serving as your own trustee of a revocable trust. Business as usual. If you have an incapacitating event, you have your successor trustee step in. At that point, you should get a tax identification number because they're now managing the assets for you. Still a grantor trust, still coming back to you on your 1040. And incapacity, as I mentioned earlier, is typically determined by either a physician or a court. The revocable trust management of assets, you can draft in provisions to tell your trustee if you're incapacitated, how you want investments done. This is particularly important if you own a business. And very often we have two sections of the trust cordoned off, one for business assets, one for non-business assets, so that you have a team of people managing the business and perhaps your family managing the non-business assets. And we want it administered for the grantor, spouse, and certain dependents so that special needs beneficiaries and other dependents can be taken care of by the trust. The irrevocable trust, this is where we're a little different. You have someone else as your trustee at inception. The income comes back to you. Principal, for accounting purposes, stays in the trust, can be distributed to beneficiaries. You take out the income. As a grantor trust, which most of these are, almost all, we would have the ability to treat capital gains tax back to the grantor. So if you sell your home, you may know that you have a $250,000 exclusion from capital gains tax based upon the Internal Revenue Code, Section 121. Your trust keeps that because it is a grantor trust, and the principal goes to the remainder beneficiaries. Again, they have no restrictions on their use. So selecting a trustee is very, very important. Who are you going to choose? It's you at the inception of a revocable trust. The Medicaid trust, typically it's family members. Sometimes for tax purposes, we use Delaware and we need a Delaware trustee. But there are times when a corporate trustee is going to provide you with significant value. And we just happen to have a corporate trustee with us today. And I'd like to bring Michael Bates back on to talk about Trustco Bank and the role of a corporate trustee and how it can help enhance your trust plan. Michael.
Good afternoon, Lou, and thank you very again for the opportunity to talk to your clients. And thank you everybody out there for taking the time to listen. It's a wonderful day, and what we're going to do is try to tell you a little bit about what we do over here at Trustco Bank. First, let me tell you a little bit about what I do. And basically, my job is as a business development officer is to meet with the clients of the bank. Although I meet with a lot of clients that are not customers of the bank, they're provided by attorneys that I might see or CPAs that I might see from here down to Westchester. I got a pretty big territory. But mostly my job is to do a lot of financial planning for our clients and customers who need that kind of help. And I take a holistic look at that kind of thing. I look at to see what their investments are doing. And if they're good, I'll let them know they're good. But if they're not, I'll give them a proposal to do it a little differently. I also look at how well they have managed their estate documents. Do they have wills, power of attorneys, trust set up? If they don't, I'm going to work on connecting them with an attorney that can get that job done, help them put their wishes down on paper, help them inventory their assets so that when they do see an attorney, they're in a good place to get going right away. So that's kind of what I do. What Trustco does is three things. And there's a menu of services in your handouts. We do estate administration, trust administration, and we do investment management. Investment management is most of our business, but we have many, many trusts that we administer here as a corporate trustee. We also liquidate estates as a corporate executor. So the menu is threefold there. Those handouts are there. You can read through that a little bit, gives you a little bit more information. In addition, your handouts have investment performance because we are investment managers. We do stocks, bonds, and mutual funds like many out there do. And of course, we do it a little differently, and I'll explain it as we go along. The trust administration fee schedule's in there, and the estate administration fee schedule's in there. Now you can read through those, but if you get confused by those, just please simply call me up. You can contact me at any time, and I'll walk you through it and talk about your needs. Let's take a step over here. Do I have control of the keyboard of the slides?
You should. You may need to click on the arrow that will appear on the bottom left of your screen.
There we go. All right, this is the description of the handouts. I'll move ahead a little bit. Now it's playing games with me a little bit here. We'll get there. There we go. All right, what does a corporate trustee do? We don't have to name Trustco Bank. Let's talk in general here. Any corporate trustee, any other banker that has a trust department. Well, they would provide professional investment management and trust services. We would uphold the standards of the Prudent Investor Act because that is what you will find from a corporate trustee, that they will have to uphold a fiduciary standard, a standard that basically states that, I'll say it in a roundabout way, it's a gray area. Basically, we have to provide investment management just as if you, in a prudent fashion, just as if you were managing your own money under similar circumstances. A prudent person managing their own money under similar circumstances. That's a high standard. We will professionally review the client's investment accounts in conjunction with the trust agreement as we make trust disbursements. There are two people, by the way, over here on every trust administration. That is the investment manager as well as the trust administrator. We will prepare and file annual federal and state fiduciary tax returns, although I will say to you that we can provide just basically informational returns and give them to your CPA. So if you have a family CPA, and I encourage you to use a family CPA and keep it congruent with the past. So we'll provide those returns and send them there. Let me take on the next slide. What are the benefits of using a corporate trustee? Well, trust administration, as Lou has kind of been hinting on, is a long and complicated process. Family members can become burdened by the time and the attention needed. How many of you have managed trusts or managed just simply financial affairs for somebody? It can become a full-time job. So having a corporate trustee manage this, manage the assets, manage the trust is a very, very good way of thinking about moving forward. A bank or trust company has the resources and the expertise to do this. Corporate trustees administer trusts on an unbiased manner and can make independent decisions that can be difficult for family members. Think about your own family dynamic there. I know personally in my family, there's some things going on. I'm a trustee of that, but Trustco is the successor of that trust. God forbid something should happen to me. Corporate trustees are bonded, they're insured, and they're highly regulated. We have the experience, the accountability, and the reliability. That's the point I'd like to bring out to handle this job for you. I'm going to take the next step here and talk about just what we do for estates. We are an estate administrator as well. Basically, we can, by the way, to back up a little bit, I just want to say that as a corporate trustee, we can be the trustee, a corporate trustee, we can be a successor trustee, we can be a co-trustee with someone else. back over to the estates. We can serve as an executor, a co-executor, or a successor, or an agent for the executor. Working in tandem with an attorney and accountant in performing any administration tasks that have to do with liquidating your estate. An executor of an estate has a responsibility for safeguarding the assets of your estate, payment of proper debts, contesting improper claims, collecting sums owed by the estate, and filing estate and income tax returns. Your executor must decide what assets to sell and when to pay taxes and estate expenses. Also, your executor needs to make timely and accurate distributions to your beneficiary or to the trust you establish for their benefit. These characteristics are characteristics of an ideal executor, in that unquestionable integrity and freedom from personal bias, familiarity with special tax consequences and questions, professional full-time investment management. These are the qualities that you should have in administrating someone's estate. I'm going to go on to the next slide. The other part of our menu is investment management. Any trustee is going to take over managing money. Trustco will provide professional and investment management advisory services. What we do in the area of managing money, stocks, bonds, and mutual funds, of course, basically you're hiring a money manager. Okay, so we're going to put together a portfolio. It's going to be an allocation of fixed income and equities, stocks, bonds, and mutual funds. It's going to be toward your risk tolerance and your time horizon for the money. Although under a trust, you'll find that most allocations are more in a balanced sense, following more along the lines of the Prudent Investor Act. Any questions about that, please don't hesitate to reach out to me and to talk about an allocation of investments in a trust. We're going to customize that investment portfolio to meet your needs as well as your beneficiaries' needs. We're going to manage both. We can manage both qualified and non-qualified accounts. That simply means a qualified account is something that is like an IRA, a 401k, or a 403b that you would move into an IRA. Those are qualified accounts. Non-qualified accounts are basically your liquid accounts. You'll get monthly statements from us or from any investment manager. We'll provide detailed statements of income and expenses and capital gains. Very, very helpful to most CPAs. We have very in-depth information reporting over at Trustco, and many accountants appreciate that a great deal. Bill paying services, something Lewis told me that is a bigger value than I feel it is from time to time, but I've learned that, many of the clients that we work with at some point in time, going to need help paying their bills, whether that be arthritis in the hands and you can't even pick up a pen, to just basically not wanting to do it anymore. So a bill paying service is available at Trustco if you're a client. The fee schedules incorporate both asset management and trust services. Over here, our fee schedule does incorporate the investment management and the trust administration under one fee, okay? If we are your agent of the trust managing your investments, that's a separate fee schedule, but it's not that different. It's not that much different. So having one fee schedule for two jobs, I think is a wonderful thing over here, and it's very well appreciated by many families that do business with us. That's pretty much it for us. I like to go through these things very, very quickly. I don't like to take up too much time. After all, I am basically tooting our horn, but I'll give it back to you, Lou, to move forward. Thank you.
Thanks, Michael. And depending upon your family and your circumstances, having a corporate fiduciary can make all the difference in the world to ensure that the trust is administered properly, that the tax returns are timely filed because they're the trustee, they're responsible for that the investments are managed properly. And as Michael said, that's one bundled fee for investment management and the trust administration services. And I just want to point out one other thing. Many of our clients want to have a corporate trustee, but they don't want to turn all of the things over to a corporate trustee. So very often we will name a co-trustee. So you can have a family member working with Trustco or any other corporate fiduciary. So there is still family involvement, family control. And sorry, Mike, but we always give the family the power to change trustees. So if it isn't working out, you can always change to another corporate fiduciary, a different company, if it's not doing what you want it to do. So good design, flexibility.
What are you really saying there, Lou?
Sorry, Mike.
Thank you.
So let's get into the nitty gritty a little bit, into the weeds, if you will, and bring David back to talk about the actual tax returns that a trust files. David?
Thanks, Lou. Let's see. If my keyboard will work. I just want to jump back real quick. This was not planned, but I have to say we are a very, very old CPA firm. We've been around over 100 years. Trustco's been around a long time. We have a lot of mutual clients, and Michael's right in so many ways. They prepare some 1041s that we don't do, and then we get them for our clients for their personal returns. Their bill paying services are phenomenal. We have a number of elderly clients that all the kids are out of state. So they take care of the bills, they take care of everything. And I have to say that their reporting that they send to the accountants to do the tax returns when they don't prepare them themselves are extraordinary. So I will tout that, Michael. They're phenomenal. So anyone considering that should definitely consider Trustco. So for the reporting, for the revocable, and we've talked about this a little bit before, if it's a revocable trust, the income just gets reported on your 1040, on your personal return. It's very simple and very easy. If it's irrevocable and it needs to have a 1041, you need to show your income, your deductions, distributions to the beneficiaries, and exemptions. It's similar to your 1040. So I'll go through the form in a second, but so for the income, you're generally going to have your interest and dividends, which are predominantly what you'll have in the trust. Sometimes you'll have some passive income from the rental properties or other things that you have going on. You may have capital gains from some stock transactions. You might have some tax exempt income as well. There's a lot of different types of income you can have. The deductions are going to be similar but different that you have for your personal return. Your tax deduction, your attorney and accounting fee deduction, your trustee deductions fees. So you actually can lower the taxable amount of that income. You have your distributions, which is, as you'll see, it's almost like the net of what's left that gets distributed to the beneficiary. So it comes down to as close to a wash as possible. And you always have a small exemption. So depending on the type of trust that's set up, it can be it can be $100, $300, $600 exemption. Different ones have even a higher, special needs have a higher exemption. But there you go, business income. I missed one, business income. So you can have all sorts of income inside the trust, just as you do on your individual return. The fiduciary fees and the interest, you might have an interest. So if you transfer property into there and you have mortgage interest, that's deductible. If you have margin interest on your investment accounts, that's deductible. Some administrative expenses are deductible. There's a lot of similarities between the trust return and the individual return. It's really a matter of knowing what is deductible and where to list it. So for the form, the 1041 itself, so this is set up as a simple trust. So you have to check the proper box. There's a number of boxes there. Some you may never even have a need to concern yourself with. The basic ones are going to be the simple trust, the complex trust, and the grantor trust. Those are the ones that we're speaking about today, and those are the ones that are really the most prevalent ones that you'll see. So you'll list the name of the trust, you'll list the name of the trustee, the address, the federal ID number. You will check any potential boxes. So if it's a first year, you'll check initial. It could be an amended return. We do some amended returns occasionally when mostly when mutual funds reclassify income after they've already issued a 1099. And you'll just list the income. So in this slide, it shows interest income. It shows dividend income. And then, so we have the total there. We're going to deduct the interest that's listed. We're going to deduct the taxes that were paid. And I apologize, I keep skipping ahead because I have the full page, so I'm sorry. So the interest and tax deduction is a $12,000 deduction. So you subtract that $12,000 from the $33,000, and it gives you a net number of the $21,500 you can see at the bottom of the screen. That number is the amount that will be distributed out to the beneficiaries. but you're allowed to lower the taxability of that income by taking those deductions, which is fantastic. If you potentially, if there were some attorney's fees or trustees fees, accounting fees, other fees in there, that would also lower it. So it helps in the sense that your the income is 33,000, but the amount that's taxed is a much lower number. So you'll see, I went backwards, I apologize. So for the grantor sheet, it's going to list the ordinary and qualified dividends. And I'm hoping that many of you understand that not all dividends are qualified dividends. They are taxed at a different rate, but it will list both. And if you have your Form 10 open on your screen, you can see the full page and you'll see the other items listed on there. But it simply becomes a flow through to your return. So those numbers get listed on your Schedule B for your personal tax return on the 1040. And this is the other example. So the grantor letter is for the grantor trust. And then this K1 is actually listed for a typical 1041 where you have, generally speaking, it's complex. Sometimes it's simple, but it will flow through the income and it will list the dollar amount in both the ordinary dividends and the qualified dividends. You'll notice that there's no interest listed because the expenses offset the interest first. There's a scale of which expenses offset which income items as it goes through. Not that you need to know that, but I just wanted to explain it. So those numbers are literally what get, so it's essentially a 1099 that you'll get from a bank or from a brokerage house. That number gets listed onto your personal return, and that's the amount that you pay tax on. So again, you're able to deduct that $12,000 in expenses right there, as opposed to on your personal return, it's very possible you're taking the standard deduction. So you may not benefit from those items on there. So it works out, in this particular case, it works out perfectly so that you get a maximum benefit of the deductions and a lower flow through of the income, therefore a lower tax issue. And I don't know if there was one, no, I'm going to go back. So I'm going to babble for a second. I apologize. So I'm passionate about estate planning. I had an issue with my grandmother 30 years ago. And if it were not for estate planning, things would not have worked out properly. I will say you need to also make sure that all of the kids are on the same page. So the parents need to speak to the kids ahead of time so that they know what's going on. The co-trustee issue is a fantastic idea because many times, if it's not the oldest child, it's one of the, call it a favorite child, whatever you want to call it, the child that's nearest is going to be the person that's going to be the trustee on there. And sometimes it's not in their best interest to try and make a decision that will affect their siblings. And having that co-trustee that's independent, they can come in and actually say, this is what needs to be done and take that burden off of the trustee. And it really makes for a better family situation. And I'm speaking from experience, it really does make for a better family situation because that happened in my family. And my aunts and my mother did not speak for a while because of that. So a co-trustee would have been a fantastic thing in that case. But again, making sure everyone's on the same page. Once the parents talk to Lou and they know what they want to do, and I'm pretty sure Lou does encourage this, make sure you speak with the kids. Make sure they understand that this is your wish, that you want them to do it this way. And that's really the most important thing to completing a true estate plan, is making sure everyone is on the same page.
David, I couldn't agree more. And that's part of having a good team, making sure all your professionals and all your family members are on the same page. And I just want to point out, and Dave, if you want to pop back on real quick, when the tax law changed, it changed and exemptions went up, income tax rates went down, but they disallowed a whole bunch of deductions.
Right.
And most people are familiar with the SALT deductions that went away. So your state and local taxes, your property taxes, your state income tax, you can't deduct anymore unless you go through some complicated partnership stuff if you have a business.
Right.
But they also took away the ability to deduct accounting and attorney's fees for individuals, which kind of hit us a little bit, because otherwise they could have deducted it. But this is one of the big areas of distinction when you have a trust.
Oh, absolutely, because you can deduct those dollar for dollar against the income that you're generating. So it's a true offset. It's a true, nowhere else, at least on your personal return, can you get that dollar for dollar deduction. and get a benefit by lowering your tax on your personal return than having it flow through the trust like that.
Absolutely. All right, we have about, let's see, 6 minutes to go, and we do have some questions that we are going to get to. So just to give you a little heads up, I'm going to finish this up, and then we're going to do the questions that you have posted in chat. So duration of probate administration. A lot of people ask, well, what does probate cost? How long does it last? Pre-COVID, it was a much simpler process. COVID has put the courts in a little bit of a backlog, and a probate estate has to stay open a minimum of 7 months from the date you get letters testamentary. Well, what does that mean? So when someone dies, you have to take the will, go to court, probate the will, petition the court for approval. The court then has to review everything. If there are minor beneficiaries or disabled beneficiaries, they appoint a guardian ad litem. It can take years, literally, in some cases, minimum of 1 year, usually between 1 and 2 years, but for complicated estates, it can take even more. And David said, if you want to see the people come out of the woodwork when something happens, when a person dies, and you have all the potential beneficiaries coming out in an estate that's going through probate, it gets to be very complicated and very messy. So all of these probate pitfalls can be easily avoided through the use of a trust. The revocable trust or irrevocable trust is outside of probate. You don't have the court fees. You don't have to search for beneficiaries or heirs. You don't have executors' commissions, the legal fees, serving process on various parties in a probate proceeding, a bond if it's not waived in the documents, accounting fees, appraisal fees, guardian ad litem that I mentioned for disabled and minor beneficiaries. All of these things go away, and your trust is very simple to administer. And if it's well drafted and well tailored to your needs, there's going to be clarity there as to who is in, who is out as beneficiaries, what exactly their interests are in the trust, and who's in charge. You get to determine all of that. So people say, well, I can't control it from the grave. Truth is, you can. And you can make sure that your family gets along and that things go as planned. No probate, manage assets, provide for successor trustees upon disability or death in the trust, and privacy. A lot of people are very concerned about their affairs becoming public. Probate, you can go down to the surrogate's court in your county and see the estate, not only the will, but what's in each estate, the assets of anybody. There are no private probate proceedings. They're all public. So revocable trust administration, if it's a married couple, when one spouse dies and they have a joint trust, that trust simply continues on for the benefit of the survivor. If they are above that $6 million level, we're going to do some tax planning in the trust. Again, no necessity to run through court just to do the tax planning. It happens privately and expediently inside of the trust document. So you can literally double the exemption available to a married couple from 6 million state to 12 million state, and from 12 million federal to $24 million federally. Married couples right now can eliminate $24 million from their taxable estate. Huge potential planning opportunity. So we use a lot of different types of marital funding to do this. I'm not going to get into all of that detail. When the second spouse dies, we have assets that then are paying the bills, making sure that everything is accounted for. We will create trusts for certain beneficiaries. And a lot of people know if you have a special needs, a disabled beneficiary, you want to make sure you have a special needs trust carved out for them in your trust. But what a lot of people don't think about is creating a trust for healthy children who would otherwise inherit outright, but you want to have them be able to protect assets upon your death. And as I mentioned earlier, this is one of the things that we're doing now, that whenever I talk to parents, and I am one, I have 3 20-somethings, and I don't want the things I've worked my lifetime for to simply go into their names and out to some divorce lawyer who's going to fight for them and run them through the ringer. I don't want them to get sued and lose their inheritance to a lawsuit or bankruptcy, or God forbid they have a health crisis and everything I leave to them is exposed to their healthcare needs. We can create trusts for our children or any third party, nieces, nephews, brothers, sisters, even parents, that we call a beneficiary control trust. So they can actually be the trustee or co-trustee of their own trust. They can manage it for their own benefit. They can have full use of the money under a standard called health, education, maintenance, and support. And yet that trust is exempt for divorce, lawsuits, bankruptcy, and Medicaid. We call this a beneficiary control trust. And when you do a revocable trust or an irrevocable trust, a living trust for yourself, this trust simply sits nascent inside that trust. And upon your death, it blossoms. It's contained right in your trust. And because it has a very low cost threshold. It's easy to put in place now, and it then becomes administered by your children upon your death. And it is an excellent way to make sure that your children are protected with the wealth that you want to leave them. So when someone dies, you've got a whole slew of things that happen. You have to file the decedent's final 1040. If it's an estate, you have to file a 1041. If it's a trust, you also have to file a 1041. If their estate is up over the tax threshold, you may have to file a New York State ET 706, it's called, the state tax return. If it's up around the $12 million threshold, you file a 706. And you have opportunities to plan. So just because someone is deceased doesn't mean that the planning opportunities go away. We can choose tax years. We can choose how to deduct expenses. So the collaboration between the accountant, the attorney, and the financial advisors, even post-death, becomes extremely important because you have so many tax options available to you at that time. Accountings, to whom does the trustee account? To the beneficiaries. They're a fiduciary serving on behalf of the beneficiaries. So you have to know that if you're serving as trustee and something happens, goes awry in the trust, you can be called into court to file an accounting if a beneficiary files that request. So you want to make sure that you're keeping good books and records. And going back to having that co-trustee relationship, if you have Trustco as your co-trustee, you have an ability to have someone who has great accounting systems who can prepare this accounting for you when the time comes. So, all right, accounting in a trust is a very complicated transaction, and it's done well by some individuals, accounting firms, but trustees that are corporate trustees have a leg up because they have the technology available to track all of those transactions as they occur. So once you get this trust plan done and you've gone through the process of drafting and revisions and execution of your trust, you get to halftime, you play the second half out, your trust is fully funded. Then you want to get into a system where you're maintaining your plan. How often do you need to review it? Well, if it's a complicated plan, you want to review it every year. If it's a very basic plan, maybe once every 3 or 4 years, but you want to keep it fresh. And we have a program in our firm that we've had for well over 20 years. And we have literally clients that have been with us for that long, 20, 21 years in this program. We call it a Professional Advocates Lifetime Maintenance System. We use the acronym PALMS for short. And what we do is we create a private secure website for you. We store your documents there. We store all of your data there. It prepares financial spreadsheets for you. That's accessible to you 24/7 in a secured environment. We get access to it. And we also, once a year, meet with you to go over all of the schedules and all of the documents to make sure your plan stays fresh and current. And it also will give you access to the law firm, 2 hours a year of free telephone time. And we charge a total of $850 a year for the entire service. That includes the technology, the phone time, and the annual meeting. And if you add all that up, it's going to price out a lot more than that. So we think it's a value for clients that want to make sure their plan is current and want to keep track of things and have access to all of the documents and data that they need 24/7, anywhere they have internet access. And that's our PALMS program. In your materials is an actual contract, the PALMS agreement that we utilize. So if you're interested in PALMS, take a look at item number 12, Form 12 in your materials. And that is our PALMS agreement. So our next quarterly trust workshop will be in May. Again, always check the website. If you think this is valuable, please recommend it to a friend. And we'll be coming out in May with our next workshop. Hopefully by then, the Omicron variant will die down and we'll be able to meet back in person and share a sandwich and soda and some information and live. We always like that best, but this has been good too. We're glad that you could join us today. Every Saturday morning, Life Happens Radio. It's our show in its 10th year on WGY 810 AM 1031 FM. Please join us. Tell your friends. We talk about all of these kinds of issues every Saturday from 11 to 12. And if you get a question that you want answered and you don't want to pay a legal fee, we'll answer it for free on the radio. But you have to call in. It's a live show. So every Saturday, tune in to Life Happens. And again, I want to thank David and Michael for joining us today, and TM BYXBEE and Trustco Bank for participating, along with Pierro, Connor, and Strauss. I want to thank all of you for joining us.